Hey everybody, this is a really important video. Today, Apple stock hit a 52-week low. It is at its lowest point of the last year. I'm going to talk about if I think Apple stock could crash to $100 a share, which is another 20% drop from here. I'm going to talk about if that could happen, and if so, what would have to take place in order for Apple to drop to $100 a share. All right, so here you can see it, Apple's 52-week range, 126.04 is the 52-week low. That's right now, and it was trading all the way up to 182.94 a share. That's great, right? The year-to-date performance, but all that is stock price, right? Let's talk about what's actually happened with the business and how the business is valued today versus how it's been valued in the past. And if we look at this, it tells us the probability or the possibility okay, a couple things on this chart. Right over here, we can see the blended price to earnings ratio. This is a way that people value stocks. Price to earnings is 21.22. What this green box shows is the earnings growth rate, how fast they have grown earnings per share annually over the life of the chart that you see on the screen, which now goes back to 2009. So we can see since 2009, on average each year, they've grown earnings at 24%. Then this orange line is the price to earnings growth rate. So if earnings is growing at 24.15%, this orange line would represent a PE that equals the earnings growth rate. So right now it's 24.15%. And what you can see is that historically, Apple has traded below its earnings growth rate, which kind of makes sense. And then we can see the normal PE ratio. So on average, since 2009, Apple's PE ratio has been 18.39. That's represented by this blue line here. And what we can see is that Apple is currently trading way above its historical average PE. What I immediately notice here is that Apple appeared to be trading at a much lower on average price to earnings ratio pre-COVID than post-COVID. And so the question for us all to think about is Apple worth a higher multiple, a premium multiple now after COVID than it was before COVID? And if so, why? One reason, if somebody believes that, could be that they think Apple has a competitive advantage now that it didn't have before. Maybe it has a stronger balance sheet. It's less risky for some reason. Or it means that their margins are improving, their business is improving, or their growth rate is improving. So they're growing earnings per share faster, or they're growing revenue faster. Well, I can tell you for a fact that Apple is not expected to grow earnings per share faster in 2023, 24, and 25 than it did in, say, 2017, 18, and even to 2019. So you can see in 2017, Apple grew earnings at 11% per share. 2018, it grew at 29% per share. And then in 2019, it grew at 0%, but still you went from 230 in earnings to 297 in a matter of 2 years, basically. For 2023, earnings are only expected to grow 1%. And then in 2024, 9%, in 2025, 6%. And these are with pretty bullish expectations. What happens if we enter some type of economic slowdown or something like that? I would guess that these are going to come down. So that last scenario, that Apple is growing faster, in my opinion, is less likely to happen. And so what I want to do is I want to take out this post-COVID period and see if that changes the normal average price to earnings ratio. And then we'll start to get an idea of what should the price to earnings ratio be of this stock if it's trading kind of in its normal range, because I don't think post-COVID is its normal range. And so now if we take out post-COVID, we see that the normal price to earnings ratio since 2009 has been 15.93, so basically 16. And we see over this time period, the earnings growth rate has been 29.47%. But I can see this wacky year right here. So let's just go ahead and take 2010 out because that's a 141% earnings growth rate year. That's kind of wacky. Okay, I've cleaned this up and I've taken out some of the outlier years, right, to get basically an average earnings growth rate from 2012 to 2019. That's a 7-year period. Average earnings growth rate has been 9.4%, and it's traded at a normalized price to earnings ratio during that time of about 15. So for about 10% annual earnings growth rate, you get a PE ratio of around 15. Now we're jumping over to a graph that shows analyst estimates for earnings for the next 3 years. And this, we can then check what Apple's price at certain PE ratios would be. And I'll walk you through this, so just stay with me, okay? So down here, you can see earnings per share of 611. That's September 30th, 2022. That is Apple's fiscal year. So the end of their next fiscal year is September 30th, 2023. Analysts are expecting $6.18 in earnings. That is about a 1.16% growth rate. Then in 2024, they're expecting $6.76 for a 9.3% growth. And then in 2025, $7.16 of earnings for a growth rate of 5.92%. And so what that looks like on average over the next 3 years, analysts are expecting 5.48% earnings growth. And so now we can build our scenario out. What does it look like if Apple trades with 5% earnings growth? What does it look like if Apple trades down to a price to earnings ratio of 15 by the end of their fiscal year 2025, by September 30th, 2025? If that happens, Apple's share price would be $107 a share. So that means the share price is 17.41% lower, but you'd be getting paid a dividend, right? So you get your annual dividend. And so instead of losing 17.4%, you would be losing 15%. And that's total. From today to then, you'd be losing 15%. Now, I would say that is probably a, bearish or, worst case type scenario for a company that's as solid as Apple, is that by 2025, it's still trading at $107 a share, right? I don't see Apple, unless something crazy happens, crashing way further than that for that long. Okay, so I think $107 a share by 2025 is kind of the worst case scenario. I think Apple trading closer to a price to earnings ratio of 18 at that point is probably my base case. I would say that's the most realistic scenario for Apple, I think. And so that means at that time, by September 30th, 2025, if Apple's trading at a PE of 18 and hits these earnings growth numbers, then you've got a share price of $128 a share, which means that the share price is actually down almost 1%, but you've gotten your dividend. And so your total return with the share price being down and getting your dividend is 1.28%. Not a great return, right? Now, let's say we're very bullish on Apple and we think they're either going to do better earnings than what is expected, or they're going to trade at a higher price to earnings multiple. Then we can go on the high side, and this is at a price to earnings multiple of 22.5 in 2025. It would trade at a share price of $161 a share. That means that it would have capital appreciation or share price appreciation of 23.89%. Then you're getting your dividend, and so that means your total return is going to be 26.06% through September 30th, 2025 for an annual rate of return of 8.75%. Now, what investors have to think about is, what do you think is the most likely scenario? Is it the bear case of a PE of 15 and losing 15%? Is it the base case of PE of 18 and gaining 1.28%? Or is it the bull case of 22.5 and gaining a total return of 26% for 8.75% per year? Which one of those do you think is most likely? And with that in mind, in your opinion, does it make sense to invest in Apple? This is my opinion only. I think the most likely thing is that Apple trades somewhere around a PE of 18. So that means, shares will be slightly down or up modestly, between 128 and 135, 140 by 2025. And because of that, with my stage as an investor, I'm early in my career. I plan to be adding to my portfolio for a long time. Apple is not a stock that I feel I need to own. Sure, it's safe and secure, but I don't need safety and security right now. I want solid companies, solid growth companies, but I want a little bit more upside than what I think Apple has. Now, what I think could happen over the short term is that Apple could trade down from 130 a share. If it trades down right now to a PE of 18 by 12/31/2022, so the end of this year, then you'd get a share price of 110. If it trades down to a price to earnings ratio of 16.5, you would get that share price of $101 a share. If Apple traded down to between $110 a share and $101 a share, then I'd be a lot more interested in owning Apple because it is such a solid company. And then I think I would have potential upside, from $101 a share up to that price to earnings ratio of 18 out to 2025, up to that 128, $135 share price. That's some nice upside there. Then you're talking about, a 30% return, a 35, maybe a 40% return over the next, 2.5 years at that point. So if we see Apple get down to between $110 and $100 a share, I'd be much more interested in owning it than with it at $130 a share right now. Now, we can see I'm in the minority here. Analyst price targets on Apple are a high, and this is through 2023, so they think this can happen by 2023. A high of $224 a share, an average of $179 a share. That's the average price target on Apple stock, or a low of $123. So right now, it's basically at its low analyst price target. And I just don't see how analysts are getting there. I don't see how they're so bullish on Apple stock, given this is their revenue growth estimated change, compound annual growth rate through 2027, 2.65% per year on the low side, up to 4% on the high side. So for 4% revenue growth per year on the high side, they're thinking that it has upside to potentially $224 a share. To me, that's kind of insane. And then same thing with earnings per share. On the low side, expecting 5% growth per year through 2027, compound annual growth rate. And then on the high side, 6.52%. So they're not expecting crazy revenue growth or earnings per share growth, but they still have, pretty heightened analyst price estimates. And I think that this is because it's unpopular to be bearish on Apple right now. And, analysts take risks when they go out there and they put, differentiated price targets on a stock. If they're wrong, then they take risks. They'd rather just be the same as everybody else. And then when everybody's wrong, it doesn't really matter, at least for them, because they were just like everyone else is doing it too. But if they come out and they're super bearish on Apple and everyone else is bullish, then they look like an idiot if they're wrong, right? So I think we could see analyst price targets come down. That generally happens as a stock comes down. And so, yeah, it'll be really interesting to see. If you learn anything from this video, you can support me by liking the video and subscribing to this channel. That helps other people find our videos, and that helps you make sure you get all the videos that I put out. And then let me know in the comments, do you own Apple stock? Are you bullish? Do you think I'm too bearish? What am I missing? What are your thoughts on Apple stock? And what do you think about the analysis that I did? Thanks for watching. I hope you have a great day.